You followed every single rule in your playbook. The setup was clean, the risk was defined. The entry was precise. You did everything right and the trade still stopped you out. Then the market reversed and went exactly where you thought it would go. That moment right there is one of the most demoralizing experiences in trading. Because you didn't break your rules. You didn't chase. You didn't revenge trade. You did the work and still walked away with a loss. So you start questioning everything. Maybe the strategy is broken. Maybe you're just not cut out for this after all. But here's what nobody tells you in that moment of doubt. Taking good trades and still losing money is not a strategy problem. And once you understand the math, everything you thought you knew about trading shifts completely. Today, we're breaking down exactly why good trades produce losing results and what actually fixes it, not surface-level tips. The real mechanical reason your account isn't growing the way it should. If nobody's explained this to you before, subscribe right now. Hit the like button too, it genuinely helps more traders find this channel. Let's give this problem a name. It's called the good trade illusion. The good trade illusion is when you confuse trade quality with account growth. You believe that if you take good trades consistently, your account will grow consistently. That sounds completely logical. It's also dangerously incomplete, because a good trade is not defined by its outcome, it's defined by its process. A trade can follow every rule perfectly and still result in a loss. That is not a contradiction. That is how probability works in real markets. And most traders never truly accept that even after months of hearing it. They say they accept it. But every losing good trade still shakes their confidence. Every stopped-out clean entry still makes them question their system. That gap between what they say they believe and how they actually react. That's the trap. The good trade illusion keeps traders stuck in a loop of doubt and strategy switching. And it's the reason good traders with good systems are still losing money every month. Here's a real number that should completely reframe how you think about this. Research on professional fund managers shows something deeply uncomfortable. Even the top-performing traders in the world lose on 40 to 50% of their trades. Not retail traders, not beginners. The absolute best in the world losing nearly half their trades. So if professionals lose on almost every other trade, what makes them profitable? It is not their win rate. It is what happens on the trades they win versus the trades they lose. Their winners are significantly larger than their losers every single time consistently. That asymmetry between wins and losses is the entire foundation of sustainable profitability. Not picking the right trades more often. Sizing the wins and losses correctly every time. A study from the University of California found something even more revealing. Retail traders have an average win rate that's actually higher than institutional traders. Retail traders win more often and still lose more money overall. That is the paradox. They win small and lose big. Professionals win big and lose small. Same market, opposite results. And the difference has nothing to do with strategy quality. Let's build this out slowly because the numbers are going to surprise you. Imagine two traders both using the exact same strategy with the same 55% win rate. Trader A wins an average of 1R on winning trades, loses an average of 1.5R on losers. Trader B wins an average of 2R on winning trades, loses an average of 1R on losers. Same strategy, same market, same win rate. Watch what happens over 100 trades. Trader A, 55 wins at 1R equals plus 55R. 45 losses at 1.5R equals 67.5R, net result 12.5R. Trader A is a losing trader with a winning strategy and a majority win rate. Trader B, 55 wins at 2R plus 110R. 45 losses at 1R equals 45R. Net result, plus 65R. Trader B is significantly profitable with the exact same entries and the exact same win rate. The only difference is how they manage the trade after entry. One let winners breathe. One cut winners short and held losers longer. Now apply that to a $10,000 account where 1R equals $100. Trader A lost $12.5 to $250 over $100. Trader on $250 over 100 trades while winning the majority of the time. Trader B made $6,500 over the same 100 trades using the exact same entry signals. That $7,750 difference was created entirely after the entry, not during it. This is the single most important number you will ever see about why good trades lose money. Right now, some of you are thinking a very specific thought. But my problem is different. My entries are actually the issue. Or maybe my strategy genuinely doesn't have a good enough edge. That might be true for some of you, but probably not for the reason you think. Go back and look at your last 50 trades with one specific question in mind. Not did you win or lose. Ask this instead: where did you actually exit? Did you exit at your original target, or did you exit early because you got nervous? Did you move your stop loss tighter because the trade was uncomfortable and slow? Did you take a small profit at 0.5R because the market looked like it might reverse? Most traders who audit their trades discover something shocking about their data. Their theoretical results, where the trade would have gone at original targets, are profitable. Their actual results, where they actually exited, are losing or break even. The strategy was working the whole time. The interference was coming from the trader. That is the real objection to address. Not whether the strategy works, but whether you let it work. Drop a comment below if you've ever exited early and then watched the trade hit your original target. You'll see how common this actually is, and the fix is coming right now. Here's the moment where this video is going to challenge what you believe about yourself. You've been operating under the assumption that the market is your opponent, that the institutions are hunting your stops, that the algorithms are against you personally. And while liquidity dynamics are real, they're not your primary problem right now. Your primary problem is that your brain is biologically wired to sabotage your trading. This is not an insult, this is neuroscience. And it's working against every trader equally. Your brain processes financial losses in the same region that processes physical threats. Losing money activates the same survival response as genuine physical danger. That means when a trade goes against you, your brain triggers fight or flight mode. And in fight or flight mode, your prefrontal cortex, the rational thinking part, goes offline. You stop thinking like a trader. You start reacting like an animal under threat. That's why you move stop losses. That's why you exit winners too early. That's why you size up after a winning streak and size down after a losing one. None of those decisions are strategic. All of them are biological survival responses. The market didn't break your strategy. Your own nervous system did. And that realization changes everything about how you need to approach this game going forward. Let's break down the 3 specific things that turn good trades into losing results. These aren't abstract concepts. Every struggling trader is doing at least one of these right now. No one exiting winners before the target. This is by far the most common and most costly mistake in all of retail trading. The trade is up 0.8R. The original target is at 2R. You start second-guessing the setup. You close the trade for 0.8R thinking you're protecting profit and being disciplined. But what you're actually doing is systematically destroying your risk-reward ratio every week. Do this 20 times in a month and your 1-2 strategy becomes a $1.8 strategy which barely breaks even. Protecting small profits while letting full losses run is the fastest way to a losing account. No 2. Moving stop losses when the trade feels uncomfortable. The trade hits your stop zone. You're convinced it's going to bounce any second now. You move the stop 10 pips lower, then 10 more. Then you're sitting on a 3R loss. That single decision just wiped out 3 winning trades worth of gains in one moment. And the worst part, you made that decision thinking you were being smart and flexible. A stop loss is not a suggestion. It is the line where your analysis was proven wrong. Moving it doesn't change the trade. It just delays accepting that you were wrong about the direction. No 3 inconsistent position sizing based on confidence levels. You love this setup, so you risk 3%. You're unsure about that one, so you risk 0.5%. Your most confident trades are not statistically your best trades. The data proves this repeatedly. Oversizing on emotional conviction turns one bad confident trade into a week of damage. When your position size fluctuates with your feelings, your edge becomes completely unpredictable. Flat, consistent sizing is not boring. It is what makes the math work in your favor over time. But step 1, backtest your exits, not just your entries. Go back through your last 30 trades and record 2 exit prices for each trade. First, where you actually exited. Second, where your original target was placed. Calculate your actual R multiple versus your theoretical R multiple across all 30 trades. The gap between those two numbers is the exact amount your interference is costing you monthly. Most traders discover their strategy was profitable the whole time, they just kept overriding it. Step 2. Create a trade management rule set and treat it like your entry rules. Most traders have strict entry rules but zero rules for managing the trade after entry. Write down exactly what conditions would cause you to exit before your target is hit. Not feelings, not fear. Specific price action conditions that invalidate your original thesis. If those conditions don't appear, you do not touch the trade until it hits target or stop. This one rule alone will improve your average R multiple within the first 30 days of applying it. Step 3. Lock your position size for 60 consecutive trading days. Pick your risk percentage right now. 1% is a solid starting point for most traders. Apply that exact percentage to every single trade for the next 60 trading days without exception. No increasing because you feel confident. No decreasing because you're in a losing streak. The same number, every trade, 60 days straight. No negotiation with yourself on this. At the end of 60 days, you'll have data that finally shows you what your edge actually is. Let's step back and look at what this really means for your life beyond the charts. Every trader who burns through an account doesn't just lose money, they lose time. Months or years of market hours that taught them the wrong lessons about why they lost. They blame the broker. They blamed the strategy. They blamed market manipulation. But the real reason was sitting in their trade management the entire time. And here's the brutal truth about the timeline this creates for most traders. Someone who takes 5 years to understand trade management versus 2 years is not just 3 years behind. They're 3 years of compounding behind. 3 years of account growth behind. At 3% monthly returns, which is achievable with proper management, 3 extra years means this. The trader who figured it out in year 2 has over tripled their account by year 5. The trader who figured it out in year 5 is just getting started at the same point. This isn't just about trading. This is about what financial freedom actually costs you in time. Every month you spend taking good trades badly managed is a month you're paying full price for a delayed life. The freedom you're trading toward gets pushed further back with every mismanaged winner. That's the real stake. And that's why this conversation matters far beyond just improving your win rate. Here's the one thing you need to carry out of this video today. Your entries are probably not the problem. Read that sentence again. Your entries are probably not the problem. The signal that tells you to get in that part is likely working better than you think. What's breaking down is everything that happens after you click that buy or sell button. The moment the trade is live, your biology takes over and starts fighting your strategy. And until you build systems that remove emotion from trade management, your good trades will keep losing. Not because the market is wrong, not because your analysis is bad, because you keep interfering with a process that was working when you left it alone. The best trade management decision you can make is usually the one you make before you enter. Set the target, set the stop, define your exit conditions, then step back and let it play out. The traders who master that discipline not perfectly, but consistently, are the ones who make it. They're not smarter than you. They're not more talented than you. They just stopped fighting their own trades, and that made all the difference. You already know how to find good trades. Now you need to learn how to leave them alone. That's the edge. That's the thing the 5% figured out that the 95% never did. And now you know it too. If this video reframed how you think about trade management, subscribe and watch the next video on screen right now. It covers why most traders fail in the first year and the exact habits that keep the 5% profitable long term. See you there.